Hey everybody, good to be here today. My name is Brent Moores and time for Advanced Option Strategies. And we do this class each week at this time. And today I want to talk to you a little bit about market volatility. Have you seen some market volatility lately? Yeah. So I want to talk to you about one approach to trading the current market volatility. That is long iron condors. What's a long iron condor? Have you ever heard of that? Uh, we'll discuss shortly. Any case, I'm joined alongside Barb Armstrong in the chat, helping me out. Appreciate Barb. And you can follow either of us on X at Brent Moores CS, at Barb Armstrong CS. And before we start to get into the content today, let me just mention that options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of any security strategy or chart type. Paper money application, paper money software application, where you're going to use the Thinkorswim desktop application, is for educational purposes only. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including risk of loss. And let's see, probability analysis results are theoretical in nature. We'll use delta today, probably, for some probabilities. It's theoretical, folks. It's all theoretical probabilities. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And there's no guarantee an execution of a stop order will be at or near the stop price. There we go. So let's go to the Thinkorswim platform. And first I want to talk about the markets and market volatility, because you can see, well, you guys have all experienced this lately. This is the S&P 500. You can see the pullback. Of course, every day we get an upward day. We're up 1.7% today. You know, there's hope in your heart that things are going to turn around perhaps. And that I don't know where the market bottom is. In fact, to kind of start us out, I thought maybe I'd go through some historical pullbacks to try and identify, help us decide when we're going to hit that market bottom. Because what a lot of traders like to do is they like to look what they kind of call capitulation in the market. Capitulation. It's a big word, but it means, finally the market just gives up on the downside, and then finally that extra selling on the downside, you get a stronger buying situation. So let's take a look at the markets, and I'm going to go back to COVID, and we'll look at some more pullbacks that we've had since then. But so what I'm going to do is I'm going to change my time frame on this chart, and I'm going to go to to be safe, I'll go 10-year daily chart, and I'm going to zoom in to here. We'll go here to, and so this is 2020 right now. This was when the COVID, shut down. You guys all remember this. And let me just go forward a little bit in time. So in hindsight, of course, this is hindsight. What happened before? We had this kind of downtrend and a lot of down days, and then we reversed itself. We had a down day, and then we had kind of a gap up bullish day, followed by another bullish day, followed by another big bullish day, small pullback, and then that was the reversal. But so we had 3 pretty good bullish days in a row there on that, after kind of this gap down bottom. So that's what happened. And that, what's happened in the past is certainly no indication of what's going to happen in the future. Let's go down to 2022 now. And I'm going to go to about October of 2022. And look, we had a pretty good pullback. Where am I at? Did I have my dates right? October of 2022. Oh yeah. So I'd like to actually zoom out just a little bit. Not going to zoom, nope. Let me try that. Okay, there we go. So here was 2022. We had a pretty substantial pullback in 2022. And so during this time when the market was pulling back, I don't remember the exact, I mean, this was actually a pretty long pullback. 2022 was a lousy year in the market, to be honest. And that's a substantial pullback from 4,300 down to what do we hit, about 3,500 from a percentage wise. So what did we see here on the turnaround? The first day of the turnaround was a huge green candle. In this case, in the chat, Chris said it'd be nice to see a close engulfing candle, a big engulfing candle. That's exactly what we saw right here on this one. This was what we'd kind of call this was a change in the market. This big candle, in fact, look, it engulfed those 3 previous days. It doesn't mean we're always going to get a big engulfing candle, but we did get was we had a pullback of several down days in a row, and then a big old green candle. That's kind of a nice sign on that one that occurred. Let's go forward in time to the next one. And the next one was just a year later. We had a pretty good pullback in October of 2023. So this was a couple years ago. We had a pullback from what was that, 4,600 down to about 4,100. So that was well over a 10% pullback. We had 3 big down days in a row, and then it was just release the hounds, folks. It was just they went after it, man. We went I don't know how many days in a row up, but there were big days in a row up too. So that was kind of that turnaround that we had there. Let's look at a couple more. Let's go down to 2024. That's I think I'm on 2024. Let's go to April. This was a smaller pullback, but it was a pullback. It was a decent pullback. We had 1, 2, 3, 4, 5, 6 down days in a row, and then a couple up days in a row. That was the reversal there. And let me do one more. We're going to go down to last October, where we had this pullback. And what do we have? We had big gap days down, huge gap days down. And then on this gap day, we actually closed a little bit higher than where we opened. It was a big down day, no doubt, but we closed a little bit higher than we opened, and then just kind of straight up from there. So let's go to current day. How are we going to know? I don't know how we're going to know. I don't know if it's going to be different this time, but what we have seen is we've seen a lot of down days interspersed with one green day. Down, 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 interspersed with one green day. Down, green day, down, green day. So in other words, I think a lot of technicians would probably say what we're seeing today probably isn't enough to convince a lot of technicians that this is the bottom right here yet. We never know the bottom at the time. You know, someone may have gotten lucky and bought right down there, and maybe the market just goes up from here. We don't know where the bottom is. What we can also see, though, is we can also see, and then I want to start to get to talk about trading here on this, but what we've seen is we've seen this drop in implied volatility. The VIX up from close to 30 down to 22. It's still elevated, but clearly the market volatility is pulling back. And so that's what we're seeing right now. And BJ in the chat said we need to see some more follow through. I think a lot of people would agree with you on that there, BJ. So what we're seeing though is the market has one day a turnaround, but the VIX has been turning around. Implied volatilities as a whole have been pulling it around for a few days. So we're seeing lower volatility. So one concern in doing strategies and doing option strategies is this implied volatility drop, assuming it's the same on individual stocks, whatever stock you're looking at, can certainly harm certain types of trades. It hurts trades that are long vega trades such as, say, just doing a long put, or maybe you feel this is a turnaround and it's just doing a long call or doing a long straddle. All these trades that I just mentioned are long vega trades. So implied volatility is going to hurt you on that. A drop, if it drops, if it continues to drop, that is. It could go up, but if it continues to drop. The thing is about it going up is typically when it's gone up, it hasn't stayed up for a super long period of time. Okay. Now you can say, well, what I'm interested Um, what would be interesting is what about trades that benefit from an implied volatility drop? So short Vega trades. And for those of you who have never heard of Vega before, bear with me. This is more of an intermediate to advanced level class, so I'm assuming you've heard of some of these factors here before. And we do have a getting started with options class if you like as well. But stick with me. I'll try and go through this stuff in a way that's understandable. But stocks or trades that benefit when implied volatility drops, those short Vega trades, you can think of some of them, something like a short put or a short call would benefit. Iron condors, short iron condors, which is the kind of standard iron condor trade that we do, it would benefit if implied volatility drops. And short straddles would benefit in that case. But there is a challenge with these. Often these have kind of poor reward to risk profiles. Like if you just do a short put, you could potentially lose a lot more than you could potentially gain on a short put. Okay. Or an iron condor, the way we normally do them, your reward to risk isn't very good. And also in the case of like an iron condor, a short iron condor, you can't have the market move much. Well, that's a problem right now if you think the market is likely to move much. Here's the SPX again. If you think this is likely, if it recovers, it's going to go up a lot, or if it's going to go down, it's going to continue to go down a lot, the short iron condor is problematic from that standpoint. So what I want to talk to you about today is doing a long iron condor, and there's pros and cons on the long iron condor. On a long iron condor, basically what we're going to do is we're going to do a long call vertical out of the money. We're going to do a long put vertical out of the money. Now I'm doing this, I'm just showing you on SPX right now, but this would be true on any stock that we're looking at. Don't confuse this with a short iron condor where we're doing a short call vertical and a short put vertical. These are long call verticals and long put verticals. In general, these are going to be Vega positive, which means that a drop in implied volatility would hurt them. However, because we're doing the spread, instead of just doing a long call and a long put, it's going to mellow that Vega out significantly. And I'll show you that in a little bit. So it's probably not going to be a negative Vega trade, but if we can reduce that Vega a lot, it's probably going to be a much less significant thing. If you think of those things that affect an options price, the stock price move, time value decay, and volatility moves, if we're getting a big move, and that's kind of what the principle of this trade is, if we're getting a big move in the stock, this more than likely is going to kind of be a much more significant factor than time decay or volatility moves, especially if we can mellow out those volatility moves. So that's the theory on this. By doing a long call vertical and long put vertical, doing that long iron condor, furthermore, as opposed to doing, say, a long straddle, it's going to cut the cost down of the trade. We did a long straddle the other day in a different class, and the market hasn't been moving. It was a pretty expensive trade, and we're losing money on that right now. And so this, by doing a long call vertical instead of just a long call, and doing a long put vertical instead of just a long put, our initial cost on the trade is going to be significantly reduced. Now, there's a consequence to that. Our gains will be reduced too. We're limiting our gains out on that by doing the vertical instead of just the straddle there. There we go. Okay. So let's take a look at some examples. Mike, what I want to do here is I want to look, I wanted to look at the overall markets and market volatility to start, but I want to discuss placing long iron condors using some example trades. That's our goal here, okay? So let me get out of this little tool here, and I'm going to just pull up a stock here. I'm going to pull up Visa just as an initial example. You can see Visa was just doing really, really well. In fact, we were in a long, a leap call on it for a while. We got stopped out of that. It was doing really well for us. We got stopped out, but now it's just dropped significantly. Is this going to bounce up? Is it going to go to? It's moving a fair amount. But let's look at this as just kind of an example trade. Remember, this is a trade where we're looking for significant movement in Visa. It doesn't matter whether that movement is up or down. We just want it to move a lot. What we don't want is we don't want Visa to stay kind of in this range here. That would be not the good situation there on that. That would be a less desirable situation. Furthermore, if Visa were to continue down, our implied volatility would probably stay relatively elevated on it, you would think. Or at least it may not go up, but it may not go down a lot. So our implied volatility issues aren't the case there. And if it goes up, implied volatility could work against us a little bit. But let me just show you how we can possibly address that, how this trade possibly addresses that a little bit. So what I'm going to do is I'm going to go to Visa, and I'm going to go out a little bit. We'll go out 21 days. We'll go out about 3 weeks. Give it a little time here. And I'm going to do a long call vertical. And what I'm going to do is I'm going to use a delta, okay, a delta to try and help target a price, okay, a strike price for our long contracts. So delta tells us how much any option is going to move in comparison to a $1 move in the underlying stock, but we're also going to use it as kind of a means of choosing a strike price here. So kind of just a general guideline, if we start picking deltas that are around 30 for our long contract, what that's going to mean is it's going to be a higher probability trade, but it's also going to be a lower reward to risk ratio on it. Okay, if we look at deltas that are closer to 20, and I'll demonstrate this in just a sec, then it's going to be a lower probability trade. So this is opposite of short iron condor. Long iron condor going out farther is going to be a lower probability trade because we need it to move, but it's going to be a higher reward to risk ratio there on this. So Isaiah said, are we doing a long iron condor? The answer is yes, we are doing a long iron condor. And Chris said, would this be a strategy you could consider before an earnings? Yeah, you could consider this before an earnings as well. So I have a column here for Vega. Now, so we're going to look at the Vega column, we're going to look at the Delta column. I'm going to go out and I'm going to look at, let's see, here's a 32 delta on this. So if I do this, this is going to be a lower, this is going to be a higher probability trade if I do something like this, but a lower return on risk on that. So I'm going to try and demonstrate a couple today, one with a higher probability, one with a lower probability. But let's look at the Vega here. The Vega here is 28. Now, if I go and I buy this 340 and I sell the 345, my Vega, instead of that 28, I think I just changed to 29, is just going to be the difference between those. So my Vega, and I kind of covered them up with my chicken scratch there, but that is about a 5-point difference in those. So in other words, I've reduced that Vega from a pretty, 29 Vega down to about 0.05. So if we were to get a drop in implied volatilities, it would hurt us less. That's true for earnings, as Chris was pointing out before. Okay, so let's do this. Let's look at this example here. We're going to go and let me get it out of my drawing tool. And I'm going to go to a 3, what do we say, 32. I'm going to buy the 340. I'm going to click on the ask price. I'm going to sell. I'm going to hold down my control key, the bid price. I'm going to do a similar thing on the put side of things. I'm going to go to, well, we don't have exactly. I'm going to go to 27 delta on that. I'm going to buy that one, and I'm going to sell this one. Okay. There's my iron condor, my long iron condor. Notice it's green there. Okay. This is green. And so normal iron condors, it would show up as a pink color, but this is a debit transaction. So if we do this, now what I'm going to do is I'm going to actually, let me analyze this trade. I'm going to analyze this trade, and we're going to look at this. That's what this trade looks like. So we said we were doing April 4th, excuse me. So let me change this to April 4th. Go to April 5th there. This should be today's date, which it is. Let me set my slices to break even. Okay, there we go. So it's roughly a 50-50 trade here on this. And so where's our break even points? So about 48% chance of losing, that would make it about a 52% chance of winning on this trade. And you can see the difference between the break-even points and our gain, max loss, and that's going to be fairly similar. 248 max loss, 252 gain. Okay, so in this case, because of what we chose, we're going to call this roughly a 50-50 probability, slightly better, and roughly a 1-to-1 reward to risk, basically, there on this. So this is kind of balancing it out here a little bit. Now, so just from the probability standpoint, remember these are just theoretical. We're reliant on our expectation that this is going to move. Now, you can do this certainly with more volatile stocks. In fact, I'm going to look at a more volatile stock on our next one. And Isaiah brought up, what about more volatile stocks? Well, you can do that, but there's no free lunches, folks. You can find more volatile stocks, but the numbers are going to work out. You're going to pay more for them, okay? Because of higher implied volatilities. So more volatile stocks are more expensive stocks. So don't just look for more volatile stocks. But that is a consideration, our volatility on this. Okay, so there's that right now. And what I can do is let me get out of my drawing tool. I can go over here. I can set my slices to the chart. And let's get rid of this line because that's an extra line there. There's my break-even points on this trade right here. Stocks right here, right now, right where my cursor is. There's my break-even point. Where do I want it to go? Don't get in short iron condor mode where we want it to stay in between here. We want it to move, and we have about 3 weeks for it to move below here. Now, at the rate it's going, for the amount we've seen, it wouldn't be surprising, perhaps, for it to move beyond these. But I don't know. Maybe it mellows out right in here. And in that case, it would work against us. Okay? So there we go. So, question from Paul: do I have an example plan for a long iron condor? I'm not familiar with one that we've made, but we can make one together here. That's kind of what we're doing today. We're going to use liquid options. We're going to find stocks that we think are going to move. Our delta on our short strikes are going to be, as I mentioned before, maybe 20 to 30. That's for this class. These are just examples. These aren't recommendations of exactly what you need to do. 20 to 30. Here we did a little bit of a higher probability trade, but return on risk, roughly 1-to-1 on that, okay? Now, one thing I would also say here is, I don't want to lose the whole thing. And so what I may do is I may put an exit in if we have lost half of our money there, for example. Now you may go, half our money, that, you know, is that we're already there? Well, this is at expiration. This blue line is at expiration. The purple line represents where we're at today. Over time, if this is, we'll say this is going to be negative theta right here, and it'll be positive theta there, positive theta there. But if we stay kind of in this range, this is going down. So let's say if we lose half of our money on this, then we'll look to exit there. So I'm going to put a 50% stop loss on that. Okay. Now, Bridget said, hey, look, how would this compare to a strangle? Well, it would be somewhat similar to a strangle, but keep in mind, one of the benefits, there's pros and cons. On a strangle, the difference is our gains would just keep going up and up and up. Our gains wouldn't cap out there on a strangle. Gains would go up and up and up. They wouldn't cap out there. That's the downside versus the strangle, okay? But here's the difference. Our losses would be worse too, would potentially be worse there on that strangle. Because remember, by selling those contracts, we're cutting our initial debit down. So I'm not saying which is better. The other benefit of this is this cuts down on the Vega impacts on it in case volatilities go down. Okay, so hopefully that answers your question there. Those are good questions, by the way, from you. So I appreciate that. Let me just pull this up here in a little bit and just see if it will let me. Yeah, let me go out of this and let me do custom here. Is it going to let me do this? Strangle. Boom. Oops. Let's see if I can get that to 0 and get this to 0. Come on, it's not showing me. I don't know why I took that off there. Okay, in any case, I kind of drew it out for you. So there's the trade. And so I'm going to put in that stop at about 50%. So about 250. So if we get down to about 125, 130, somewhere that, then we'll look to exit that. So I'm going to click on first trigger sequential. I'm going to right click on this. I'm going to create an opposite order, one to get us out. And I'm just going to make this a stop. Stop. Remember, stops aren't guaranteed to get us out. I'll go to 130, just a smidge above a 50% loss there. That's going to be a good till canceled order. Remember, stops aren't guaranteed to get us out at the 130. This could go against us quicker on that. That's the goal, okay? So there we go. I'm going to click on confirm and send. And I'm going to put this, where am I going to put this? Just going to throw this, I'm just going to leave this undefined right now, okay? In my unallocated area. Make sure you read your stuff here. And before you send. Max profit, max loss, and it's not giving us a break even, but we already looked at those break evens. Let's send that order. Okay, there we go, we filled. All right. So, you know, Bridget made a comment, and I think some of us have experienced this. Bridget said, you know, every time I do an iron condor, I lose. Well, this is just doing the opposite, you know, and you're going to be going, well, just my luck. The time when I think, you know, I lose on iron condor because it moves too much. And then finally you're going to pick the stock that doesn't move at all on me. But, you know, I guess that's trading, huh? Sometimes that happens. Let's look at a stock that maybe has a little bit more volatility. NVIDIA. You guys are all familiar with NVIDIA here. And in fact, you can look at your implied volatility. I think you can see implied volatilities are dropping a little bit on NVIDIA. They certainly have more they could go, but they're starting to drop a little bit. Part of that may be, this is a little different than the SPX. Remember the SPX, we said SPX was actually implied volatilities were dropping even though XPX was kind of going down. Not today, but here it's dropping mostly in coinciding with the move up in NVIDIA here. So here's NVIDIA. Is it going to go up or down? I don't know, but this is a more volatile type stock. Those of you who have been watching NVIDIA knows that it can move, and it's in the spotlight quite a bit here. So I'm going to do this. I'm going to go out and let's look at our trade. Oh, before I do that, let me just mention this. If you see a strong resistance or support, then maybe you wouldn't consider this. But if you see like a potential room on both sides, that may make more sense here. So let's go to NVIDIA. So here's NVIDIA, and let's do a different expiration date, just because we don't need to be stuck to any expiration date. We'll go to April 11th. One advantage of going to like April 11th versus April 17th is you're going to get more strikes here. Why does that matter? Well, on some stocks, at least, I don't know about NVIDIA here, like here we got a $5 difference in strikes. So if you're looking for that delta and you want to go, say, between a 30 and 40 delta or something, excuse me, a 20 and 30 delta, well, sometimes it works out that you don't have anything that fits the bill there on that. So in this case, it actually does. In fact, we'll stick with April 17th because I think we got this. So let's go and do something that's a little bit farther out of the money. I'm going to do the 110 strike. I'm going to target that. Remember, I'm going 20 to 30. 20 is going to be a lower probability trade. 30 is going to be a higher probability trade. I'm going to go right in the middle, 25. I'm going to buy that. I'm going to sell, $5 gap down. I'm going to go up here. I'm going to buy the 135. I'm going to sell the 140. There's our long iron condor. Okay. Well, let's analyze it again. Let's go right click. We're going to analyze a trade. Here we go. Okay. Let's say we said, what was our expiration on that? We said April 17th. So I'm going to go up here. It's switched for us to April 18th. That's what we want. This is the current date. We're going to set our slices to break even. Okay. Let me just move this in here. Look at that. That's actually, it actually didn't. Interesting. I don't know if it's an implied volatility thing. I suspect maybe it is. I'm surprised we're not. Oh, actually, let me uncheck that. Let me reset my slices to break even. Well, I think it's a longer dated option. Again, this one's about a 50-50. 49%, 51% gain, 49% loss on this one. But we can do the same thing. We can set those slices to the chart. Now, let me just, to illustrate the point, if you go out further on this, let's say we went to 140, 145. Because right now, if I do this and look at this, let me confirm and send here real quick. My max profit, you see, this isn't terrible in terms of what we're looking at. Max profit about 300, max loss about 200. Well, on a 50-50 trade, that's not such a terrible thing. Let me right click and analyze that again. I don't know why that kicked me off. I'm going to stick with that trade there. So look, we can still lose if the stock is 50-50 from the probability, from the theoretical probability standpoint of winning, losing on this. But we actually stand to gain more than we stand to lose on this. So there we go. Let's add our slices to the chart. Set slices to chart. There's NVIDIA. Okay. Probably wider slices than what we saw in Visa, but it's a bigger mover company. Okay. It tends to move more than Visa. So we'll see on that. We need the stock to move, this is positive up here, this is positive down here. If it kind of goes in here, and in normal markets, I'd be going, well, that seems like a pretty wide, but in this market, you guys have been sitting through this market. You know what it's like right now. There's the higher volatilities. I'm going to, I don't know why I did that. I'm just going to click on confirm and send, and I'm going to send. Okay. So we sent that one. Let's look one more here. One more example. And a lot of times for my examples, someone mentioned Tesla earlier. Actually, I would have considered an example on Tesla, but we already have a trade on Tesla on a different stock. So I try and spread the wealth, so to speak, between these examples and just show you different examples. Here's a stock that has moved hugely. Okay. It's had a gap down today. We're a little higher than that. But you can see, like, just recently, our stock was up close to 140 and down in this range, down to 115, 110 range. So obvious huge possibilities. I'm wondering I haven't looked, what's our implied volatility? Implied volatilities aren't ridiculous on this. So here's one though. Let me just look at my delta. You see, with strikes $5 apart, you're limited on when you're choosing your delta. Look, I have the choice between a 38 delta and a 21 delta there. So if I want more strikes, I can go out. Let me do April 11th here. The one downside of going to like April 11th, these weekly options is, in addition to different expiration date, often there's less liquidity on these. But let's do this. Let's go, and I'm going to go down and let me get a few more strikes here. And I'm going to let's go all the way to a 19 delta, just to kind of show you the difference here on this. I'm going to click on the ask price. I'm going to click on the bid price, control click on the bid price. I'm going to go out of the money a ways, control click on the ask price, control click on the bid price. Okay, there we go. Now the spreads aren't great on this. This would be one where maybe the weekly options would probably give us a little better spread. I'm going to certainly look to try and get filled closer to that mid price than the natural price on that. We may not be able to get filled exactly at the mid price, but that's kind of the goal here. Let me right click on this. Let me analyze this trade. Oh, I have some other trade in there, I can tell on this. Why is this? Hold on. Something's weird on this. That is not right. There's something wrong with this here. Let me just look. Did I misclick something? 134. Oh, somehow I added a different extra contract in there. That's why that does not look right. There we go. That's looking right now. Okay. You see how you can tell when the graph doesn't look right, you go, something's wrong there. Well, that's what we did here. So let's do the same thing we did, but what we're going to do is April 11th. So let me just go up here. It goes April 12th. So that's switched. And let's set our slices to break even. Okay. So, set our slices to break even at expiration. That is, I have an extra slice in there. Let me get rid of that slice. That's throwing me off. Delete that slice. There we go. So now what do we have? We have a higher chance, 72% chance of losing money on this. Okay, that's because we shifted we shifted our strikes much wider. However, there's something still, this graph is still a little screwy. This graph is something wrong here on this graph. There we go. And let me just reset those. Why that did that. There we go. Okay. Oh, no. Well, okay. This is a little surprising, to be honest. Let's take a look here on this. 134, 135. This looks right. I'm surprised our probability is showing as good as it is because we went out as wide as it is, but that looks right. I switched these around. Boy, how did I do that? No, that's right. Yeah, I don't know. But our probability is okay. Our probability is okay on that. I'm surprising it's as it is what it is. But let's right click on this. Let me just do that. Let's set our slices to the chart. Okay. Set slices to chart. Boom. There we go. I don't want Abbott. I want, yeah, that's right, Abbott. Okay. And there's our slices. I mean, just in the last 2 days, we've come down that far. So it seems certainly possible within the realm of technical possibilities that the stock could go back up to this level or below that level in that time. And there we go. And then let's go and let's confirm. Let me just double check that this did not. Yeah, this. Confirm and send this. And our max profit is higher than our max loss, significantly higher than our max loss. Of course, there's no guarantee. There's no guarantee on this of the probabilities. They're just theoretical. But I may up my number of contracts too. So let me edit this. And I'm going to make this up 2 for each of these. There we go. Confirm and send. And then I'm going to send that order. Okay. And it's thinking. Going back to what I mentioned before about, let me cancel, replace this. My mid price and you see it's trying to get filled at that 20-cent debit. That's unlikely. Mid price is at 32. Probably going to have to go above that. I don't want to go all up to that 49. Let's see if we can get filled on that. It's thinking. We'll let that run and see if that fills. Okay. So what I want to do now is I want to just kind of summarize this. Number one, if you are this trade, a long iron condor would be more appropriate if you expect a bigger move in a stock. Number two, as opposed to a long straddle, it's going to cost less, have a lower theoretical max loss. It's going to have lower vega or implied volatility effects. But you also are limiting your gains substantially as compared to a long straddle or long strangle in that case. So those are the circumstances you do that. The wider out you make your strikes, the more you need that stock to move up or down, which makes it a lower probability trade. But generally, you're going to have better reward to risk ratio if it actually does achieve those. The narrower you put those strikes to one another, something, say, closer to 30 delta, okay? That means it's higher probably you're going to get there. They don't have to travel as far to get there, but your return on risk is probably not going to be as good on those. One thing you can consider, and we did this on our Citigroup trade, is you can put a stop loss in. Stop losses aren't guaranteed, but in our example, we put a stop loss in roughly at 50% of our initial debit, okay? Just to try and lose it. Now, these aren't typically, same thing with short iron condors, these typically aren't the fastest moving trades in the world out here. So if you're doing a long call, long put, sometimes you see instant results. This one, because you have all the different legs there, it's a little bit slower moving of a trade in terms of potential gains and potential losses. All right? So there we go, everybody. Thank you very much for joining me today. Thanks, Barb, for helping me out in the chat. Please follow us on X, at Brentmore CS, at Barb Armstrong CS, and make sure you subscribe to that Trader Talks channel on Thinkorswim. I don't think we had no survey link today, so you're off the hook on that one. Coming up next, we have ThinkScript studies. Make sure you check that out. Mike Fairborn teaches that. And everybody, have a wonderful weekend. Talk to you later. Bye-bye.